Hello, and thank you for joining me today. My name is Marc Montini. My company is the Montini and Company Tax Advisory Group. And in this short webinar today, we're going to talk about investing 101 for millennials. Real briefly about us, we are a full-service tax and financial planning firm. We're a one-stop shop for all your planning needs. I am a licensed fiduciary and an independent financial advisor. I've been in financial services now for 29 years, and what I specialize in for my clients is our tax reduction and tax elimination strategies. I build long-term sustainable income plans for my clients. We manage assets, and we even do taxes that start at 175. Now, I'm calling this mini webinar Investing 101 for Millennials. What I think it should be called is If I Only Knew Then What I Know Now. And my purpose of putting this together is to get an entry-level webinar for the children and grandchildren of my clients. I want to try to fill that educational gap that we may have and try to give some real-world advice that really matters and can be and really help somebody later in their life, and show people why is it so important to become an investor and to learn how to save. We're going to talk about compound interest, IRAs, Roth IRAs, stocks, bonds, mutual funds, ETFs, employer-sponsored plans, stock market indices, different kinds of financial professionals, and finish with life insurance. I'm going to try to go as fast as I can because I don't want this to be that long. If there's anything that you like and you want more information on, I am more than happy to have a no-cost consultation with you, your grandchildren, your children, to really expand on some of these topics. So the first thing I'm going to talk about is time and compound interest. And I will say this, if you get nothing more out of this webinar, it is time and compound interest. You can never get it back, and you've got to take advantage of it. Interest is what you make. So you give me $100, I make you 5%, you now have $105. Compound interest is the interest you're making on top of your interest. So you give me $100, I make you 5%, you have $105. I now make 5% on top of that. You now have $110.25. Now I'm going to make 5% on top of that. What happens is, as that grows, we start to see an exponential growth factor that comes into play. And when you take that over 20, 30, 40 years of investing, the growth can be massive, and you can end up with a significant amount of money by the time you retire. And trust me, you will eventually retire. Eventually, you're not going to be 20. You're not going to be 30. Pretty soon, you're going to be 50. And you're going to think, oh my goodness, when I need to start saving. Well, if you take my advice now, put something in, just do something, anything, and you're going to appreciate it later in your life. Now, as a place to put your money, you can put it into an IRA, or an individual retirement account. This is called qualified money. Qualified money is money you have not paid taxes on yet. Okay. When you put your money into an IRA, that money grows tax deferred, which means you don't have to pay any taxes on any of the earnings that you make until you start taking distributions or withdrawals from that account. So you've got interest, compounding, and you're not paying any taxes on that interest that is compounding. So an IRA can be a great place to go. But an IRA, as it states, is an individual retirement account, which means you can't access that money until you're at least 59 and a half. Now, another form of qualified money is the Roth IRA. Now, remember, the traditional IRA grows tax deferred. A Roth IRA grows tax free. Okay, so the traditional IRA, you pay taxes when you take a distribution from that IRA. On the Roth IRA, all of the earnings that you've made, all of the interest that has been compounding over time, you're not paying any taxes on any of those, on any of that growth. And that distribution that you make later in life all comes out tax-free. So a Roth IRA can be a really powerful planning tool. Like the traditional IRA, you can't access the Roth until you're 59 and a half. If you do, there is an IRS penalty associated with it. Now, you could also purchase an individual account or a joint account. This is what's called non-qualified money. This is money that you have paid taxes on. So you got a job, you got a paycheck, okay? You contributed to your traditional IRA, but you can't access that money until you're 59 and a half. Here, with non-qualified money, you've paid taxes on your paycheck, okay, but you can contribute it into an individual account or a joint account if you're married. The important part about that is you can access that money before you're 59 and a half. So maybe you want to save some money to put on a down payment for a new home. Okay, a joint account could be a good place to go. The downfall of non-qualified money is that you do pay taxes along the way. So you're still getting interest and compound interest, but you're paying taxes on that growth along the way. So the exponential growth isn't quite as good as you might see out of a qualified account like an IRA or a Roth IRA. Now, you may decide, now that you have an IRA, Roth IRA, or an individual account or a joint account, where am I going to put my money? You can start with buying a stock. A stock is a federally regulated security, and it represents partial ownership into a company. Okay, so maybe you got your iPhone and you're a big fan of Apple. You think they're doing great stuff. You can buy an Apple stock. Okay, and now you own a portion of Apple. Now, that one stock is a very, very small portion of ownership, but it is still ownership nonetheless. Now, companies issue stock that you can buy so that they can generate capital to reinvest back into their company, right? So they sold you stock. They took that money that they got when they sold you the stock, and they invested it in more employees or research and development or whatever that might be. Now, over time, you bought that stock because you believed in the company, and you believe that company is going to grow and become even better than they are right now. So you bought the stock for $100, and then it grew to 150, and then it grew to 200, and then it grew to 250. Okay, that's why you buy stock. And historically, stocks have outperformed all other type of investment vehicles that you could buy. Now, when you buy stock, you're going to endure a bull market and a bear market. What that means is a bull market is when the stock market is going up, right? You bought 100, and then at $100, and it grew to 150 and 200 and 250. That is a bull market. That's a good thing. But 25% of the time, we do have a bear market. So your stock appreciated from $100 up to $250. Okay, maybe you did it inside of an IRA and you don't have to pay any taxes on that growth yet, but we're now entered into a bear market. And now that stock depreciated down from 250 down to 210, right? These things happen. And so you're going to have what's called stock market fluctuation that we want to plan for. Now, as an alternative, a safer alternative, you could buy bonds. Okay, a bond is a form of debt. Okay, and that debt is issued by a government institution or by a company. You could buy a corporate bond or a government issued bond. And what happens is you have $100. You buy that bond from that entity, whatever that entity might be, and they agree to give you interest on your money. They agree to give you 5%. Now, the issuer of that bond, either the company or the government entity that issued the bond, has a rating associated with it. And that rating is based on their ability to pay you back the original $100 that you gave them. That's their claims paying ability. Okay? Now, let's say you like stocks and you feel like, okay, I'm young, I can endure bear markets from time to time, and I really want that growth, but you don't have enough money to buy the different stocks and the different companies that you really feel are good places to go. Well, you could buy a mutual fund or an exchange traded fund. What these assets are is these are a conglomeration of different assets. Okay. One of those assets could be a stock with Apple. Another one could be a stock with Google. Another one could be a stock with Netflix, right? And all of these different stocks are held within the mutual fund or the exchange traded fund, the ETF, okay? With a mutual fund, at the center of those assets is a mutual fund manager. And that mutual fund manager is going to make decisions on which stocks to buy and sell within that one single mutual fund. But that mutual fund manager's got to get paid. Okay. So mutual funds can be a little bit more, it can be expensive. They have different fees associated with them. Well, maybe you don't want to pay additional fees. You could buy a corresponding ETF, an exchange traded fund of that mutual fund. And the assets within that ETF are going to be the same as the corresponding mutual fund, but there's no mutual fund manager in there. So the ETF is going to be significantly cheaper from a cost and fee standpoint. Now, both of these types of investments are what you're going to have access to when you participate in an employer-sponsored plan. So an employer-sponsored plan is a way for you to save for your eventual retirement and save at a faster rate than maybe you could with a traditional IRA or a Roth IRA. So if you work for a public or private company, you could contribute to a 401k. If you work for a nonprofit company, you would be contributing to their 403b. If you work for the federal government, you'd be contributing to their 457 plan. Now, the nice thing about these plans is two things. Number one, you can contribute up to $22,000 a year. Now, that can help you save awfully quickly, okay? The other benefit is most plans will offer some type of employer matching. So they will match whatever you contribute. So if you contribute $10,000, your employer may also contribute $10,000. Okay. This is the second thing that I never want you to forget. Never miss out on free money. And when your employer is matching your contributions, that is free money. So never give that up. So do something, take advantage of time and compound interest, and take advantage of employer matching. Okay. Now, how do you measure your performance, right? You bought some stocks, you bought some mutual funds or ETFs. How do you measure your performance? Well, you would do it through measuring it through a stock market index, or when you have multiple stock market indexes, they're called indices. So multiple stock market indices. Now, the most common stock market index would be the S&P 500, the Standard & Poor's 500. Okay, and this is basically the top 500 companies in the US. You can buy an ETF, an exchange traded fund, based on different stock market indices. So this is very passive management. Okay, nobody is making any decisions on what stocks to buy and sell. You just buy the one index and you get whatever the thing makes over time. Historically, the S&P 500 has been the top performing investment that you can put money into. So, but just know you get bull markets and you get bear markets, and nobody's making decisions on when to buy and when to sell. But historically, again, the S&P 500, you can buy the ETF, which is super cheap and has very, very good historical performance behind it. As you get older, you may want to explore tactical money management versus passive money management. Tactical means action. Somebody would be watching your money. Somebody would be making decisions as to what assets to buy and sell based on what the economy dictates you should be invested in. That is tactical money management. Now, there's a lot of different financial professionals that are out there, okay? And maybe you want to know, well, what's the difference between a stockbroker and a fiduciary and a financial planner and a financial, a financial advisor or an insurance-only licensed agent? There's a lot of different professionals that are out there that'll help manage these assets. And if you're interested, I got a free little mini webinar. You can go to my website, and under my webinars, you'll see financial advisor, financial planner. Take about 15 minutes and really bone up on what type of financial professional you want to work with. Now, life insurance is something to consider, especially if you're young, okay? Because life insurance, the younger you are, the cheaper that life insurance is going to be, because life insurance pays out a death benefit. So if you're 25 years old, what's the likelihood that you're going to die? Probably next to nothing. So it's like if life insurance companies will be happy to sell you a death benefit that you may not ever have to pay out. So the younger you are, the cheaper life insurance can be. Now, there's three types of life insurance. There's term, there's whole life, and there's universal life. Okay, term is going to be the cheapest because term only pays out a death benefit. That's it. So you could buy a 20-year term, and if you don't die during that 20-year term, all those premiums that you paid they go. They're just like if you paid car insurance and never crashed your car. Okay, you don't get any benefit from it. Well, you may decide that you want to accumulate cash value from your life insurance. Okay, and you can do that through whole life or universal life. Whole life is permanent insurance. That means that you pay premiums till the day you die. Okay, well, maybe you don't want to do that. Maybe you only want to pay life insurance premiums for 20 years, but you still want to have the life insurance forever. Well, you may explore universal life. With universal life, you can dictate how long you want to pay the premiums, and that's going to adjust and change what the cost of the premiums are. Now, when I talk about cash accumulating life insurance, okay, it is like a bucket, okay? That's why I use this image here, okay? Inside of the bucket, your life insurance premiums go into the bucket, and the life insurance company is adding interest into the bucket. Now, at the bottom of the bucket, there's a very small hole because you're young. As you get older, that hole gets bigger and bigger. That's the cost of the life insurance, okay? But over time, that bucket will fill up with tax-free cash accumulating benefit, cash value that you can access for whatever purpose you want to access them for. And so as you're young, this is something you also might want to look into and consider. Now, as I told you, I was going to go fast in this because I didn't want this webinar to be too long. If there's any subjects in there that you're interested in and you want more information, call my office. You reach out through this website. Okay, I'm more than happy to have a no-cost free consultation with you, your parents, your grandparents, whoever that might be, and give you whatever interest in subjects you're interested in learning more about. I can also do it via Zoom if you're interested, or we can meet one-on-one in my office. I also have an entire library of little mini webinars on my website. This is, and you can learn more about how do you mitigate stock market risk, what are Roth IRA conversions, 401k rollovers, understanding annuities, and there's so much more that I have little mini webinars on that you can keep your education going. Lastly, if you like this, if you enjoyed this subject matter, share it with your friends and family, okay? Your eventual retirement's going to happen, and it's going to be a lot more fun when you can do it with friends and family. So with that, thank you very much, and I do hope to meet with you and your parents or grandparents sometime soon.